Hello, everyone, and thank you for joining me for LLIS's November webinar. November is Long Term Care Insurance Awareness Month. So each year we like to take a little time to focus on the importance of planning for future long term care needs and discussing the various options that could be a fit for ourselves, for clients, or for loved ones. So today I'm going to talk about a lot of different aspects of long-term care planning, what different options there are for clients, and what might be a good fit for them. So I hope that you all enjoy. If you have questions throughout the presentation, please feel free to type those into the questions tab on the GoToWebinar panel. Depending on time, I will try to answer as many as I can at the end of the presentation, and if not, I will reach out to you later this week to answer any questions you have. So let's get started. What are we going to talk about today? So we are going to cover some different facts and figures of long-term care, talk about some of those statistics, talk about cost of care in different parts of our country, length of claims, all that good stuff. So we'll go over some of those facts. Then I will talk about one of the hottest topics in the long-term care market, which is rate increases. And then we will get into the specific long-term care solutions. So we'll talk about traditional long-term care, hybrid life, long-term care policies, as well as hybrid annuity options. So first, I wanted to talk to you guys about the cost of care across the country. So I wanted to show here some of the highest cost of care that we see. And the main point that I would like to show is the difference in cost of care for different types of care. So you can see in San Francisco, they notoriously have a very high cost of living. So pretty much everything is expensive in the Bay Area. For a home health aide, the daily cost is pushing $300 a day to just have someone come in the home and help out to provide medication, to provide comfort, whatever it might be. A home health aide is almost $300. But look at that in comparison to the nursing home cost, $443 a day. So if you think of all the meals, room and board, everything that is included in a private room in a nursing home, it's only $443 in comparison to that $300 a day. And let's look at Anchorage, $224 a day for home health care. But look at that nursing home cost, over $900 a day for a private room in a nursing home. In Massachusetts, across the board, they're just pretty hefty for all types of care. So you can see how these vary so differently within each area. And now let's look at some of the lowest. Jacksonville, under $200 a day in Tampa, Jacksonville, Colorado Springs for a home health aide, $246 in Austin. But for only $20 more, you can have a private room in a nursing home in Austin. So these different types of care that I'm mentioning have different median costs across the country. Whenever we're looking at benefits, unless there are specific benefits that an advisor or a client wants to see, I always look up that median cost of care in the client's area to make sure that they are covered for the actual cost of where they live. So we know how much care might cost. How long do we need care for? Well, the average claim for long-term care for women is 3.7 years, and men are on claim for an average of 2.2 years. And the bottom line is that women need care longer than men because we live longer. Because of those longer life expectancies, we are receiving care for an extended period of time at the end of our lives. Statistically speaking, whenever a husband is getting older and needs help around the house, the wife is usually who's providing majority of that care in the home. And whenever her husband passes away, there isn't necessarily someone to provide that care for the wife. So we're seeing her need more care and for an extended period of time in comparison to what men are usually receiving. So where is care received? 73% of long-term care claims start in the home, and most of them remain in the home. I think we can all agree personally, and for loved ones that we've spoken to, clients have probably mentioned this. We all want to stay at home for as long as possible before we are sent off to a facility of some kind. So, whenever we are talking about what benefits make sense for a client, I always look at the home health care costs first because we want to make sure that whatever daily or monthly benefit we have built into our long term care policy, it's going to be able to cover 100% of those home health care costs. 18% of claims are in assisted living facilities, and 9% are in nursing homes. Going back to electing and choosing that benefit, we want to make sure that we have benefits that are going to cover what we're on claim for the majority of that time. So if majority of claims are going to start and remain in the home, and there might be shorter stays in a nursing home, we don't necessarily need to insure that entire cost of a nursing home and just be able to supplement for that short stay that we're there. And how much do people use their policies? Well, I get this question a lot of how many clients actually use all their benefits? When do claims end? Well, 67% of long term care claims end due to the death of the insured. 20% of claims the insured actually recovers and they no longer need to receive benefits. And only 13% of claims are going to end because they have used and exhausted all of the benefits that they have secured in their own private policy. But when do claims begin? This isn't going to be a big surprise for any of us. I think we can agree that between 80 and 84, that seems to be the right age of when we see most of our loved ones become needing long-term care and having that long-term care event. So the highest amount of claims are going to start between age 80 and 84. Second to that, between 85 and 89. And then on that younger side, 75 and 79. So we know that the cost of care, we know how long we might be on claim, um, but how do we pay for that care knowing that it's a big possibility? Well, the first option is to self fund. So we're going to pay for that care ourselves. But there are some impacts of electing a self funding option. It's going to have a big impact on your income and your assets. So when you're paying for this cost of care that does continue to increase each year, it's going to have an effect on the ability to pay the other day-to-day expenses that you still have to pay. And if you have a long-term care event early in retirement, you're going to deplete that income that would be used for the remainder of your retirement years. And the surviving spouse is left with fewer assets to either pay for care themselves or to simply have the funds to carry out the rest of their lives. But it also has an emotional impact. And it has an impact on our family members, whether it be the burden on children who actually become the caregivers for their parents. We see a lot of caregivers have a loss of income themselves because they're having to take time off work. They're having to travel to their aging parent that needs help. And it also leaves less assets to have as a legacy to pass on to your children or grandchildren. So what's the alternative? Well, that's going to be to transfer the risk of a long-term care event by purchasing your own long-term care policy. So this could be a traditional long-term care policy or maybe a linked benefit solution like a hybrid life long-term care policy or a hybrid annuity long-term care policy. It's going to help protect income and assets so that you don't have to spend down all of your assets to qualify for Medicaid. And it's also going to protect those assets to be passed on to our beneficiaries. But the biggest thing here is that it provides choice and control of where care is needed, where it is wanted. When relying on a government assistance program like Medicaid, your options are very limited of what facilities might accept Medicaid. And those facilities might have extremely long wait times or certain bed reservation limits. It might not also be up to the standards of what you would like for a parent or what your parent wants for themselves. So you have that choice of facility. And you also aren't limited on where you're going to receive care, whether that be in the home, at an assisted living, or a nursing facility. These policies also have care coordinators that are there to assist with care plans, assist with filing claims, finding a facility within these insurance companies that provide help through a very stressful time. It also allows your family members to manage your care and not provide it. And taking that burden off of a loved one of them becoming a caregiver is is a really great option for people to have because it is a big burden to put on loved ones to take care of you. I get this question probably the most of any for long-term care of when is the right time to apply? What is the magic age to apply and start thinking about long-term care? Well, there was a few points that I wanted to mention, and that is that even while we are aging, so are our parents. And long term care insurance companies care about our family history. And it's not the normal cancer history or cardiovascular history that life insurance companies might care about. They care about cognitive impairments. So, as we're getting older and our parents are getting older, they are more likely to be diagnosed or to suffer from a cognitive impairment like Alzheimer's or dementia. One traditional long term care company we work with will not consider a client who has both parents that have been diagnosed with a cognitive impairment. So it does have a really big impact on underwriting, even when it's not something that we ourselves are suffering from. So that's something to keep in mind. Another thing to keep in mind is when we're hitting 65 and we're starting to have those Medicare health screenings, it could reveal certain medical conditions that make us uninsurable. So we're naturally incurring medical history as we get older, and long term care underwriting is quite stringent. So we need to be able to lock in that insurability early on. And in addition to locking in our insurability, we can also lock in premiums that are lower while we are younger. But Taylor, you might say, why would I lock in a premium and have to pay that premium for a longer period of time? Wouldn't I be paying in more than if I just waited? Well, let's see what that looks like. Let's look at a female, age 65, and we're assuming that she is going to go on a long term care claim at age 80. So she locks in a premium at $2,546 a year, and she's going to make that $2,500 payment over a 35-year period with a total premium paid in of a little over $89,000. At age 50, that premium is increased by 600, and in 10 years, at age 55, it's increased to $4,165 a year. So even though she's paying for 10 years less, the total premium paid in is over $104,000. And that difference continues to increase over time until a client gets to about 70, where the total premium paid in is less than at age 65, but they're paying an almost $12,000 premium. That's a really high premium for a 70-year-old who might be on a fixed income and doesn't have this cash flow that younger clients do in their working years and before retirement. So I would say, based on this overall premiums paid in addition to long term care declines by age group, that the sweet spot really is about 55 to early 60s. Because if you look at these decline rates, look at age 70 to 74. We are at almost a 50% decline rate for clients between age 70 and 74. So one out of two clients is being declined for long term care. And that shows just how difficult it can be with natural medical history that we have as we get older. So I wanted to talk a little bit more about underwriting and conversations that I have on a daily basis that can be surprising for some advisors and for clients. Long term care companies don't have several rate classes like we see in life insurance. They don't have preferred plus to standard and then additional substandard rate classes. We're pretty much seeing an approval or a decline. In some cases, the insurance company might limit the benefits that are available to the client or add a single premium rating, but it's nothing like what we're used to with life insurance underwriting. And some of the common underwriting obstacles that I see, number one is arthritis. There are a lot of varying degrees of severity for arthritis, including different medications, limitations that they might have. Physical therapy in the last 6 months. I know this is probably surprising, but I send emails every single day of clients that I receive quote requests for, letting them know that they do not qualify because they are either currently in physical therapy or they finished it within the last couple months. No matter what the reason for physical therapy is, the insurance companies will not consider a client who has had physical therapy in the last 6 months. And that's even if it is to strengthen your core or for tennis shoulder or elbow, or just being preemptive in their health to remain strong, it doesn't matter. Any physical therapy in the last 6 months is an automatic decline across the board because these insurance companies want to see stability in symptoms. They want to make sure that there aren't limitations, that the client doesn't need additional treatment, or that they're still in pain. Because you have to remember, we're thinking about activities of daily living here. So those limitations can cause a big problem later on. Changes in anxiety and depression medication. Some hybrid companies, even a small change in dosage in the last 24 months disqualifies a client from qualifying. um, Family history, neuropathy, that is a pretty much automatic decline, regardless of the reason for neuropathy. It could be from chemo treatments or diabetes. It's very difficult to get coverage with neuropathy and significant comorbidity. Clients might have some various medical history that it's really unconcerning. But the combination of those conditions together is a concern for the long term care companies. So, oftentimes, a lot of comorbidity that we see can be difficult to obtain coverage. So, now let's talk about long term care rate increases, which, is one of my favorite topics. And I talk to advisors about it every single day. So, why did we have rate increases? Well, first, we'll talk about lapse rates, we will talk about interest rates, and we will talk about underwriting. So, we'll kind of pull back the curtain on the insurance industry here. So, when long term care was first being written in the 80s and 90s, insurance companies didn't have any claims experience, right? So, they were really going based off of life insurance books. So, life insurance had a 4% lapse rate assumption. And what that means is if a company has 100,000 policies on their books, after a year, they're going to assume that there's 96,000 policies still in force, 81,500 policies still in force after 5 years, and after 10 years, only 66,500 policies in place. So, to oversimplify that, the insurance company needs $1,000 a year to pay benefits. They can charge everyone $665 since there's only going to be 66,500 policies in place that they have to pay those benefits to. Well, that did not happen. Spoiler alert, didn't happen. Out of 100,000 policies in 10 years, there were over 90,000 policies still in force. And that's a big difference from 66,000 that they anticipated. So let's oversimplify it again. The insurance company should have been charging $904, but they were charging $665. Put this on a massive scale, and that is a big error. And that is a huge reason why they needed to come back and ask for more premiums later on. Interest rates. Insurance companies collect money from clients through premium payments. They invest them to pay out claims in the future. Premium calculation determines how much to collect to pay claims. So they're basing what the premiums are needed on how much they need to pay out claims. And part of that pricing of the premium is an interest rate assumption. So in the 80s, when they first started writing these policies, interest rates were high. They were high. But unfortunately, they fell and rates declined for decades. They got low, and as Little John said, they stayed low. So the insurance companies didn't earn the interest on their premiums that they expected. So once again, another check of why they needed more money later on. They did not price these policies accurately. And not only did they not price them correctly, but they were not underwriting correctly either, because once again, they didn't have any good data on what health conditions were most concerning for long term care. If you think about how different life insurance and long term care is, life insurance, they're going to pay a claim in one scenario, and that is death. But they're worried about a client dying too early. With long term care, the companies are worried about a client living too long and needing help. So the mortality to morbidity was a really big problem in underwriting early on. So many people who were approved for policies decades ago under today's guidelines would have either been postponed. So maybe they were in physical therapy, and that ended up becoming an ongoing issue where clients could not um, complete their activities of daily living. Maybe they might be approved, but with a higher premium rate or a limited benefit length or a limited monthly benefit. Or most likely, they would have been declined altogether by today's standards. So, those are three things that had a big impact and why we see so many rate increases each year on these old policies. But good news alert, everyone. Today's policies are priced with a ton more claims experience, and they are being priced using conservative, so lower interest rates, and they are underwriting a lot more strictly. And I mean, to put it simply, the companies that are still in the long-term care market today have learned from other companies' mistakes over these years. And Society of Actuaries did a study, I believe it was 2022, that said the chance of long-term care insurance premiums for policies issued today is less than 10%. And if there is a need to have an increase in the future, the Society of Actuaries says that that increase would likely be 10% or less. And though it's never ideal to have an increase in your premium, 10% is a heck of a lot better than some of the letters that I'm seeing today of 400% increases. So that's something we can all live with. And I think that ultimately it just gives a lot of peace of mind to know whenever your clients are securing these policies and writing big checks that we do not anticipate to see anything like we have in the past for rate increases. So let's see what these rate increases actually looked like. And the difference in premiums. So this is Marguerite and Donald. They were 59 and 61 in 2004. And they purchased a long-term care policy with a $100 daily benefit, a 5-year benefit period each, 5% compound inflation rider, and they had a 20% partners discount. Their combined annual premium, $2,391. 20 years later, let's see, oh, beautiful names, female and male, 59 and 61, want to purchase the same policy today. $100 daily benefit, 5-year benefit period, and a 5% compound inflation rider. Those annual premiums are between $6,700 and $7,600 a year. So same age, same benefits, but the costs are 3 times higher initially. And what that does is it automatically, just in that premium, reduces the potential for future rate increases. So what options do we have when clients get these rate increases? Well, what I do, and hopefully I'm sure a lot of you that are tuned into this webinar have sent me those increase letters, the settlement offers from Genworth, and sent me a lot of different things for me to review. And this is what I always do. I review what they currently have in place. And usually the options are to accept the increase or to make some changes to the coverage, whether that be reduce the inflation percentage, reduce the benefit period, or even reduce that daily or monthly benefit amount. So let's look at Nancy and Andy. They purchased long-term care in 2013 with a $4,500 monthly benefit, a 3-year benefit period with shared care, 5% compound inflation rider. And when they initially purchased this policy in 2013, the annual premium was $3,635. But this year, they received a premium increase letter. And this was a staged increase. So they said over the next 3 years, your premium is going to continue to increase until it reaches $6,781 a year in 2026. So, what's the first thing that I look at? I look to see what their same policy would cost them today. And a lot of times that kind of finishes the conversation pretty quickly whenever clients are able to see and put into perspective what it costs today. So first off, they're 9 years older, which is naturally going to have an increase on the premium. And because they have that 5% compound inflation rider, their monthly benefit has grown from $4,500 to $7,697. 5% inflation riders are quite costly today, but that new premium today between $24,000 and $27,000 a year. So a $6,000 annual premium does not look too bad in comparison to what this coverage costs on the market today. Okay, Taylor, that's great that I don't have to pay 27,000, but what do I do then? Because 6,000 is still a lot and I don't like that these premiums are increasing. Well, once again, ideally clients are able to accept the increase and no one likes it, but they're paying that 30% of today's going rate. One thing to note is that 20 years or 15 years down the line, clients' health is in a completely different state than it was 15 years ago. So they might not even qualify for a new policy. But if they do want to make some changes, my very first go to is to reduce the inflation rider. And these clients had really good coverage, and I love to see when clients have some wiggle room, right, to maybe make some changes today and still leave some room to make changes later on if necessary to make sure that they have as much coverage as possible. So the letter came with an option to reduce their inflation rider from 5% to 4%. So even just with that 1% difference, it lowers the premium to under $4,000 a year. So that's kind of one of the first things I like to do. If a client has an unlimited benefit period, it's very easy to go ahead and see what options they have to reduce that unlimited benefit period to maybe 6 years or 5 years, especially if they have a joint policy with shared care. So there's always options. Usually we look to reduce that inflation rider or the benefit period, always taking into account the client's age. If they're older, reducing the inflation rider to 1% might also be a good option if they're, in their early 80s. So we're always happy to take a look. So send over those rate increase letters if you ever need some assistance and guidance on what options are available. So now let's get into the bread and butter. Let's talk about the different types of long-term care solutions. Talk about traditional, and then we'll go into hybrids. So the common features of traditional and hybrid policies is, they function very similarly. So they all are going to provide long-term care benefits and they are comprehensive. So they will all cover home health care, assisted living, and nursing home facilities. They're all going to provide a choice of benefit periods, whether that ranges from 2 years to an unlimited benefit period. And yes, there still are unlimited options. Inflation riders, whether it be from 2 to 5%, maybe a client can elect either a lifetime inflation option or limit it to only 20 years of increases. And they all have the same two claim triggers. And these triggers are what allow clients to qualify for benefits. So the first is they are diagnosed with a cognitive impairment like Alzheimer's or dementia. And because of that diagnosis, they need supervision or a specific type of care. This is an and or thing. So a client can have one or the other or both and qualify for benefits. The second is needing assistance with 2 of 6 activities of daily living. The 6 activities of daily living are eating, bathing, dressing, toileting, continence, and transferring. So if they are unable to complete 2 of those, that automatically qualifies them to start receiving their benefit period or their benefit. But now let's look at some of the differences. Death benefit. Traditional long term care is not going to provide a death benefit. It is like most other types of insurance, it's a use it or lose it type of coverage. Hybrid life does have a death benefit if no long term care benefits are used. A hybrid annuity, the annuity value, if no long term care benefits are used, is passed on to a beneficiary at death. There's no return of premium for traditional coverage, but there is for the hybrids. Premium payment. There is a limited pay option for traditional long term care, but um, generally speaking, we're looking at lifetime premiums. So the client will pay a premium until death or until claim. For hybrid life, these are going to be short pay options. So a single pay, maybe 5, 10, 15, 20-year pay. After that limited payment schedule, the policy is paid up and the client, it's there whenever the client needs it and is ready to use it. For the hybrid annuity, it is only funded with a single premium. There are no other funding options for the hybrid annuity. Traditional, as we mentioned before, those are not guaranteed premiums. So even though we don't anticipate to see these increases in the future, there is the possibility for increases. Hybrid life and hybrid annuities, those are guaranteed. Hybrid annuity is kind of obvious since you're only making one premium payment. So they can't increase that one premium payment over time. But the hybrid life policies, regardless of the payment schedule that you elect, it is guaranteed. Form of benefit payment. There are two types of benefit payment options across the board, and that is going to be reimbursement and indemnity. Reimbursement is going to be what all traditional long term care policies are. And what that says is that when you are on claim, each month you submit your expenses to the insurance company and they will reimburse you up to your daily, maximum daily or monthly benefit for qualified expenses. So, qualified expenses basically mean that you are receiving care from a licensed and skilled caregiver. So, from a legitimate organization or facility. You cannot use benefits to compensate a family member or a loved one, a friend. You can't use it to have different people come and help out around the house unless they are licensed and skilled. So the hybrid annuity and traditional LTC is going to have the reimbursement based benefits. Most hybrid life policies have what is called indemnity benefits, and these are much more flexible at claim. It's basically a cash benefit. So once you qualify to receive benefits from one of those two triggers, they are going to write you a check for your monthly benefit, and you can do with it what you want. So, whether that is providing some payment to a loved one, hiring a lawn service, hiring a grocery service, whatever it might be that you need help around the house, there are not going to be limitations to what you do with your monthly benefit. So, a ton of flexibility there in comparison to reimbursement. The underwriting, there's going to be full underwriting for traditional and hybrid life policies. The hybrid annuity is a little more limited. So, for those clients who don't qualify for the other types of long term care, the annuity is usually an option to where they will consider clients that no one else will. But that main barrier of entry is going to be the single premium. A lot of clients don't have 150,000 to write a check to fund the policy, so sometimes there are limitations there. But one version of the hybrid annuity has a 5 question application, so sometimes the underwriting can be very simple and goes pretty quickly. Partnership qualified. Long story short, with partnership, is that many states um, have kind of partnered with private long term care companies to incentivize clients to get their own policy. And what it says is you can protect assets through having your own policy. So let's say that I have a $200,000 long term care pool of benefits, and I use all $200,000 of those benefits in my policy, but I still need care. Well, partnership says that I can keep $200,000 in assets and still qualify for Medicaid to continue to receive benefits. Because I've already taken a huge burden off of the Medicaid in my state by having $200,000 of benefits that were paid directly to my facility. So the partnership is truly a partnership between your private long term care policy and the state to allow you to protect some assets and still qualify for Medicaid later on. Hybrid life and hybrid annuity policies are not partnership qualified because though they provide long term care benefits on paper, they are a life insurance contract or an annuity contract. So we're only going to get that from the traditional LTCi. So we went over this a little bit. Traditional long term care, they're going to focus on any conditions that impact your ability to complete activities of daily living. Hybrid life policies, they're going to be looking at morbidity and mortality. So they're going to care maybe a little bit more about family history of cancer, and also about your own cancer history, more so than a traditional long term care company will. And the hybrid annuity, they're only going to be looking at ADLs, but it is simplified underwriting for those ADLs. Let's look at Lauren and Harry Green. They're both 55. They live in Columbia, South Carolina, and they reached out and want to know what options they have for long term care. So, this is what I do. I did for them, and I do for any of your clients. Is the first thing I'm going to do is look at the cost of care in their area to determine what benefits make sense for them. So I looked at the median cost of care in Columbia, and for a home health care aide, the monthly cost based on 44 hours of care per week is $5,892. For a single room in an assisted living facility, $5,380 a month. And then the nursing home cost for a semi-private room, $8,616, and $9,086 for a private room in a nursing home. So based on these numbers, I have recommended a $6,000 monthly benefit. And that is because it's going to cover 100% of those home health care costs, as well as a single room in an assisted living facility. So statistically speaking, with that $6,000 monthly benefit, we are able to cover a majority, if not all, of their long-term care event, of what normally happens with a long-term care event. But if they need to go to a nursing home, 66% of those nursing home costs will be covered with the $6,000 monthly benefit. So we elected a 90-day elimination period. That's the waiting period that any policy is going to have just to make sure that you actually still need the benefits after 90 days. I think some days we can all agree that we can't complete 2 activities of daily living, but really we just don't feel that great. So the 90-day elimination or waiting period is going to be a way to make sure that the clients really do need the benefits. We elected a 3-year benefit period with shared care. When I create initial proposals that, I haven't been given direct instructions on what benefits are want to be seen, is for a married couple, I start with a 3-year benefit period with the shared care rider because that allows both spouses to have 3 years and, depending on the company, either have access to a third pool of benefits or be able to tap into the other spouse's pool of benefits. So there's more flexibility there based on those average claim lengths that we saw earlier for men and women. So this is always a really good starting point. And since I'm kind of on this topic, I'll add for a single female, I usually run a 4-year benefit period as a starting point, and for single men, a 3-year benefit period. So we have the 3-year benefit period with shared care. We also elected to have a 3% compound inflation rider. And with the 2 companies that we have access to for traditional long-term care, they can have a combined annual premium of $6,377. So with that particular company, it's a daily benefit rather than monthly. We see those kind of vary across the board with each company, um, but generally speaking, they function the exact same. So now let's talk about hybrids. Oops, that's not what I mean by hybrids. Even though I do like to see a languin, lion penguin, and maybe a suppy, a seal puppy. I don't know. Either way, I just think they're really cute. But we're actually going to talk about hybrid life policies and hybrid annuity policies. So, hybrid life policies have guaranteed benefits. That is the main advantage to hybrid life policies, is that you are going to get a guaranteed benefit for your money. This is not use it or lose it like traditional. There are guaranteed benefits, whether it is long-term care benefits or in the form of a death benefit that is passed to your beneficiaries. They have guaranteed premiums, flexible premium options, whether it be a single pay, short pay, like I mentioned, 5, 10, 15, 20 years, or lifetime pay. Personally, I normally do not recommend for clients to elect a lifetime or level pay with hybrid policies. Most hybrid companies do not have a full waiver of premium. They have a partial waiver of premium, which basically says that these clients' annual premiums have two portions, and one is a life insurance premium and one is a long-term care insurance premium. So, if a client is on a lifetime pay for a hybrid life LTC policy and they go on a long term care claim at age 80, they are still required to pay a portion of their premium, that life insurance premium, even though the death benefit is being reduced by using the long term care benefits. So, really, I personally think that these hybrid life policies are best on a single pay or a shortened schedule of payments. We can also use a 1035 exchange. So those clients that have existing permanent life insurance policies that maybe they are expensive, maybe they have a big death benefit that really isn't necessary, or maybe they are just pivoting to thinking more about planning for long term care rather than that income replacement that they've been thinking about for the previous 30 years of their life. So we can do a 1035 exchange to either fully fund a hybrid policy or maybe to partially fund so that there is a lot less premium needed to fund this new long term care and life insurance policy. And another great thing is most of these hybrid lives have indemnity benefits. So to break it down even further, hybrid life insurance policies, there's two kinds, and really they are based on different priorities. So there is going to be a hybrid life policy where the death benefit is the priority, and then there is a different type of hybrid life where the long-term care benefits are the priority. So if we look at the death benefit being the priority, here are the perks. Large death benefit. We can elect to have a monthly long term care benefit that is equal to 2 or 4% of that overall death benefit. The benefit period is either 50 or 25 months. There's no inflation protection option here, and there's no cash value. So, really, as you can see with this list of advantages or just facts about these types of policies is there's not a lot of personalization here. And that's because the main function of this is to have a death benefit and to have access to long-term care as well if you need it. So let's look at what these premiums might be. We know we wanted to keep a $6,000 monthly benefit based on the cost of care in Colombia, 50-month benefit period, $300,000 death benefit, no inflation, and these are the premiums for both Harry and Lauren. These are individual policies that they have. We don't necessarily have a joint hybrid with death benefit as the priority. There isn't really a survivorship type of policy like this. So single premium for Harry, 134,432. $120,769 for Lauren. And you can see that difference over a 10 pay and a level pay. Level pay is going to be until about age 100 here. So let's look at hybrid life where long-term care benefits are the priority. These are very similar to traditional long-term care policies. They have, you're able to choose a monthly long-term care benefit, a benefit period from 2 years to lifetime, inflation protection, 3 or 5%, and there is a small death benefit that's there if you don't need long-term care in the future. So let's see how this pans out. $6,000 monthly long-term care benefit, 4-year benefit period per spouse. This is another individual hybrid situation. 3% compound inflation. And for them, these premiums are actually, pretty similar. They are lower than the death benefit priority type of hybrid. So for a single premium for Harry, $99,162. Lauren, $113,703. A quick side note that you might have noticed here is these have flip flopped of who is paying the higher premium. And the reason for that is I mentioned this earlier about women needing care for longer. That equates to higher premiums. So when we're looking at these hybrid policies where the long-term care benefit is the priority, that's what they're going to be paying out. That's where the biggest pool of funds is going to be. It's not in a death benefit, it's in long-term care benefits. So naturally, Lauren is going to pay more for this type of hybrid than she would with the death benefit priority hybrid. They both would have $144,000 death benefits that would either go to children as a beneficiary or to each other. Um, and yes, so they're paying a little bit more with or a little bit less with this type of policy. Now let's look at joints. Someone is putting in different pictures in this PowerPoint. I do not mean that kind of joint. I mean a joint hybrid life policy, a policy that's going to cover both of our clients under one umbrella. So, a joint hybrid life is very similar to it's a long-term care priority hybrid. So it's going to pay a death benefit upon the second insured's death. This is a survivorship policy, to put it simply, regarding the death benefit. It provides long-term care benefits for both spouses. We have a lot of different benefit period options. These are shared pools. So it's not like traditional where both have their own pool of benefits. This is one shared pool. So whether it be 4 years, 6 years, or 8 years, clients can choose how that is split up depending on what life throws their way later on. There is inflation protection available, usually that 3 and 5%, simple and compound. Maybe they have a 20-year rather than lifetime. Depends on the company and depends on the state of what's exactly available. But let's look at what this might cost our clients. So still have that $6,000 monthly long-term care benefit. They elected a 6-year shared benefit period. So if we split that down the middle, they would both have 3 years of benefits. 3% compound inflation, and a $216,000 survivorship death benefit. So if no long-term care benefits were used by Lauren and Harry, upon the second insured's death, that $216,000 is paid to their beneficiaries. So it's a combined premium since this is a joint policy, and that single premium is $152,373, which is a savings of $60,492 rather than if they were getting two individual hybrid policies. So this is a really great option for clients who are both insurable, and they can go through the application process together and they're covered under one policy, which can really simplify things later down the road. So let's look at a little bit of a summary here. This is going to outline what I really like to see, outline what the premium is, and that's a combined premium for both of them. So the lowest premium here is going to be the joint hybrid life policy. The death benefit is the highest, shouldn't be a big surprise with the hybrid where the death benefit is the priority. That continues to grow over time. So the lowest death benefit is going to be for the joint hybrid life. But what I really like to see is the long-term care benefit at age 65. That's what's always really important to see is what is the growth on these benefits going to be to continue to keep up with the rising cost of care each year. So for that death benefit priority, something is better than nothing, but it's going to remain level at 6,000, and that's not going to go as far in 20, 30, 40 years. But for having that inflation rider, 14,139 a month can go a long way, especially as we saw in Colombia. So now let's look finally at the hybrid annuities. This is a fixed deferred annuity with a long-term care rider. This isn't able to be customized as much as those hybrids that we were looking at or traditional long-term care. They are going to have a set benefit pool of 96 months for a joint hybrid annuity. It's 102 months. The good thing, there is minimal underwriting. The not so good thing for a lot of clients is that single premium. Like I mentioned, sometimes that can be a barrier of entry for a lot of clients to be able to take advantage of the hybrid annuity when they don't qualify elsewhere. But you are able to add a spouse to an annuity and do a 1035 exchange. As a quick side note, because I don't have a ton of time here, but hybrid annuities are the only option we have whenever one spouse has a lot of cash value and they want to 1035 into another policy. Generally speaking, you cannot take the cash value from one insured and transfer it to a policy with two insureds, which does make sense, right? So with the hybrid annuity, actually the only solution we have for kind of getting around that, which is using a 1035 exchange from the one spouse's cash value into the annuity. And we're not able to make the other spouse a joint annuitant or, a joint owner or anything like that. But they can go through the underwriting process and they become what is called an eligible person. And they are insured under the policy for only the long term care benefits. And then, if the original spouse whose name is on the annuity passes away, that annuity value and the actual annuity itself with long term care benefits is going to the surviving spouse anyway. So that's kind of one of the interesting perks to these hybrid annuities of getting around that limitation of 1035 and into from an individual policy to a joint. For funding these policies, it's non-qualified money only. So we're not really looking at taking, putting money from an IRA into this. It's non-qualified funds only. And there is a 5% inflation option on part of the annuity. So very quickly, these hybrid annuities are kind of split into two different parts, right? So there is one that is the client's money or the accumulated value, the annuity value. That accumulated value is the money that the client put in. And that is the first of like 36 months or the first 30 months of the base policy. But then there is what's called the continuation of benefits or the COB pool, which is the insurance company's money. That is the second pool. So first, if you go on claim, you take out your own money first through those long-term care benefits, and then you start tapping into the insurance money. And where the insurance company's money, that pool of money is, that's where the inflation is going to continue to grow. So let me just kind of go through this with you. So we still have that $6,000 monthly long-term care benefit, 102-month benefit period, and $180,000 single premium. So let's look at the values here. So with $180,000 single premium, end of contract year one, the account value or the annuity value, it's already up over $2,000, almost $3,000. And you can see that the monthly long-term care benefit all the way on the right is a little over $6,000. The next year, that's at almost $6,200, almost $6,300 by year three. But this doesn't have an inflation rider on it at all. So why is that growing? Well, even without an inflation rider, there are guaranteed and projected interest rates within the annuity itself. So there is naturally going to be growth within this annuity without paying for the inflation rider. And I'm going to show you why that paying for the inflation rider gets pretty big here in just a moment. But I wanted to show the difference between the account value. So year one, that's 182. And then let's look over a little bit to the LTC rider value. That is that COB pool that I told you about. So the insurance company's money plus your money, $621,000, almost $622,000 of a total long-term care balance in year one. And that's with a $180,000 single premium. You already get, your clients already get almost $622,000 of long-term care benefits. But let's look at the hybrid annuity with inflation. So we have all of the same other benefits, $6,000 monthly benefit, 102-month benefit period with the 5% comp. That is going to require a $285,000 premium. And when we look at the values here, year one account value, $133,438. But we put in $105 more of that single premium. Well, that's because, and it shows you here how expensive that inflation rider is only on the LTC rider value. The values are going to start much lower because a huge chunk of that single premium is going to fund the inflation rider. But you are able to see still we're having natural growth in the account value, which has nothing to do with any inflation rider. But we can see how that grows on this page. So we have base policy that's growing based on the guaranteed and projected interest rates within the annuity. And the LTC rider is where we're going to see that 5% inflation growth each year. So to put it simply, client goes on claim and they are going to receive their first 30 months of benefits at whatever year they're on claim. If they're on claim at year 7, they'll receive $4,835 a month for long-term care expenses. But after the end of that 30 months, they're going to have a huge jump, a $1,000 jump in monthly benefit due to that 5% inflation rider on the long-term care rider. So that was a lot of information on hybrids. I don't know why I love these pictures so much, but I really do. And maybe I'll have to do a presentation some other day. Doubt you'll be able to get CFP CE credits for it, but I don't know. We'll see. One more thing. General rule of thumb. These are very general, but sometimes I find that advisors, they find this helpful, right? Of at least of a starting point, determining what of all these options make sense for their clients. So the first is if a client has $500,000 or less in assets, they probably cannot afford long-term care insurance premiums. They have between $2 and $3 million in assets, hybrids might be the best option for them. And clients that have over $3 million in assets can probably self-insure. Once again, this is very general. But if you're looking at a client who is in their early, mid, late 40s, high income earner, and they are open to talking about long term care, a hybrid option is going to be a really good fit for them based on the ability to pay a slightly higher premium over a shorter schedule, have that policy paid up very quickly. So it's things like this that are helpful. I see clients that have $5-6 million in assets and still want some sort of a specific pool of benefits for long-term care to once again ensure that they are leaving the legacy that they've worked so hard on over all of their working years, maybe keeping some family wealth, whatever it might be. Each client is a little bit different. So I hope that that's helpful for you. Just some housekeeping things. What makes LLIS different? Well, you are tuning into one of them. It's a free monthly webinar. We will release our schedule for next year here in the next month or two. So you're always able to join us live to get some CE credits. We save fee only advisors time and their clients' money by pre underwriting to avoid surprises. That does include every long term care solution that I covered today. I pre underwrite every single day. So, trying to find the best fit for your client and the best option to be approved for coverage is my number one goal. We have specialists in life, DI, long term care, annuities, and hybrids. I personally am able to help with life, DI, long term care, and hybrids. So let me know if there's anything I can do to help. We sponsor a lot of different associations and we love seeing you guys at conferences. We love getting emails and calls from you guys. So we just wrapped up conference season. So it was really great to see a lot of you who I know are tuned in today. And we have our client and advisor portal. Always reach out if you have questions on this. Um, I see, let's see that I do have some questions. However, we are at the very end of our hour. So, what I am going to do is I will have these questions archived so that I can reach out by email and answer those questions. Or if we need to hop on a call, please let me know. But otherwise, I really appreciate everyone tuning in today. And if there is ever anything that our team can do, please reach out. We are happy to help. All right, everybody, have a great evening, and I'll talk to everyone soon. Thanks so much.